Hello students, I am Dr. Ajay Kumar Deka, HOD, Department of Accountancy, Dispur College. Today I am going to discuss about an important topic of your subject Corporate Accounting, BCom second semester. The name of the subject is Corporate Accounting and the topic is Accounts of Holding Company, how financial statements, that is consolidated balance sheet of holding company, is prepared by the holding company. So before going to discuss about the preparation of holding company, we will discuss what is holding company. So holding company means a company who acquires majority shares of other companies. For example, if we take two companies, company A and company B, and company A has 10,000 equity shares and company B has 6,000 equity shares. If company A acquires majority of shares of company B, that is 4,000 shares out of 6,000 shares, then company A will be the holding company of company B and company B will be the subsidiary company of company A. So this is the example. Here company A has 10,000 shares and company B has 6,000 shares. So out of 6,000 shares, 4,000 shares is acquired by A Limited and remaining 2,000 shares, and these 2,000 shares are purchased by the general public. And these general public who purchase only 2,000 shares, they are known as a minority shareholders. So next step is, so after purchasing the holding company shares by the of subsidiary company, we should know there are some conditions which can be fulfilled by the holding company to become a holding company of subsidiary company. So to become a holding company, it must have subsidiaries. So and the controlling capacity should be the holding company of subsidiary company. That is, the board of directors should be controlled by the holding company and majority of shares should be controlled by the holding company. Next, you come, what is group of companies? So group of companies means the all companies. All company means the holding company as well as their subsidiaries, all together known as a group of companies. For example, if we take three companies, company A, company B and company C. If company B acquires majority shares of company C, then company C becomes the subsidiary company of company B and company B will be the holding company of company C. And after purchasing the share by the B of C company, again if company A acquires majority shares of company B, then company B and company C will be automatically the subsidiary company of company A. Here A, B, C, these three companies all together known as a group of companies. So company A will be the parent company and company B and C will be the subsidiary company. Next, what are the features of holding companies? Following are some important features of holding company. So number one, it oversees subsidiaries activities and have the power to aid or remove the senior management team of subsidiary company, but they do not participate day-to-day business activities in subsidiaries. Second condition is the investment in the subsidiary company and monitors its activity. That means holding company should invest money in the subsidiary company and monitor all the day-to-day activities of the subsidiary company. Third condition is, that is third feature is, it receives money by selling shares of subsidiaries and also receive income from dividend, interest, rent, etc. from the subsidiaries. That means to become the holding company should monitor as well as control of subsidiary companies. So these are the important features to become a holding company. After that, we should know what are the types of subsidiary companies. So basically, there are two types of subsidiary company. One is wholly owned subsidiary company and other one is partly owned subsidiary company. So wholly owned subsidiary company means if holding company purchases majority, not entire share, not majority share, whole shares. That is, for our earlier example, company has 6,000 shares. If company A acquires all the 6,000 shares of company B, then company A will be the holding of company B, and company B the wholly owned subsidiary of company A. On the other hand, if company A are not purchase entire share of company B, that is 6,000. If company A purchase more than 3,000 shares, that is more than 50% shares of company B, then company B will be the partly owned subsidiary company. So there are these two types of subsidiary companies available in our present situation as per Companies Act 2013. So after knowing this, we should know what are the steps for preparing consolidated balance sheet. So holding company at the end of the financial year should prepare the consolidated balance sheet. So consolidated balance sheet means the joint balance sheet of holding company and subsidiary company. It will be prepared by the holding company at the end of the financial year. So first step of preparing the consolidated balance sheet is computation of holding company and minority company's equity shares in the subsidiary. That is the ratio of equity shares purchased by holding company as well as by the minority interest in the subsidiary companies. So after calculating the ratios of holding and minority shareholders, by these ratios, all the profits, that is capital profits and revenue profits of the subsidiary company should be divided between holding and minority shareholders. So after calculation of ratios of equity shares, second step is elimination of investment of holding company in the subsidiaries and the share capital of subsidiaries. So second step is how much amount is invested by the holding company in subsidiaries by purchasing the shares. That invested amount should be eliminated with the share capital of subsidiary companies. That is the second step. Third step is computation of minority interest. Minority interest means the other shares. Who purchase the other shares, they are known as minority. The total value in the subsidiary companies should be calculated of the minorities value. Minorities total interest means total value of minorities in the subsidiaries should be calculated, and these minority interest should be recorded in the equity and liability side of the consolidated balance sheet under the head equity share capital. Fourth step is computation of pre-acquisition profits or pre-acquisition losses. So pre-acquisition profits means or pre-acquisition losses means the profit or loss which were earned by the subsidiary company before the purchasing shares by the holding company. So these profits should be ascertained to prepare the consolidated balance sheet, and these after computation of pre-acquisition profits or pre-acquisition losses, these profit or losses should be allocated between holding company and minority interest in the ratios. Ratios means share capital ratios. Next step is computation of post-acquisition profits or post-acquisition losses. It is also known as revenue losses or revenue profit. So these revenue profit or revenue losses should also be calculated. Revenue profit or revenue losses means the profits which is acquired by the subsidiary company after the purchasing share of holding company, share by the holding company. So from the date of purchasing the shares up to the end of the financial year, how much profit were earned by the subsidiary company, that profit is known as revenue profit. These revenue profits also allocated between holding company and minority interest in their invested ratio, in their equity share capital ratio. So next step is computation of cost of control. Cost of control means the invested amount of holding company in subsidiary companies and the total amount received in the subsidiary companies. Total amount received means value of equity share and value of capital profit. These two items, these two total value of equity share capital and total value of capital profit should be added, and this profit, this total amount, will be compared with the amount of investment, that is purchasing share. If total amount of investment is higher than the total amount received in shares as well as in capital profit, higher, then this amount is known as a capital loss. That is, it is known as a goodwill, and this goodwill is recorded in the asset side of consolidated balance sheet. On the other hand, if the invested amount is lower than the total amount received with reference to equity share capital as well as capital profit, then this difference amount, the higher amount, is known as a capital profit, and this capital profit will transfer to the capital reserves. And last point is adjustment of mutual wings. Mutual wings means those transactions which were already occurred between holding and subsidiary before the relationship created as holding and subsidiary. That means before purchasing the shares in the subsidiary by the holding company, if any transaction like purchase of stock by the holding company from subsidiaries, or purchase of stock by subsidiary company in the holding company, if such, or bills receivable or bills payable, if anything there before creation of relationship as holding and subsidiary, that transaction is known as common transactions or mutual owings. These common transactions or mutual owings should be adjusted at the time of preparation of consolidated balance sheet. So these are the simple procedure for preparation of consolidated balance sheet. So after knowing this, I will show you how a consolidated balance sheet is prepared. I show to you the format. So this is the pro forma of consolidated balance sheet. First, in the asset side, you may write non-current assets. The non-current assets should be recorded both in holding companies as well as in subsidiary companies. Therefore, current assets should also be added in holding and subsidiary. And in the equity and liability sides, first of share capital, which is the holding company's share portion of equity capital only here. Next, other equity means general reserve, surplus in the statement of PL, preliminary expenses, etc. And liability means non-current liability, both holding company and subsidiary companies. Non-current liability will be added there. Non-current liability includes sundry creditors, bills payable, etc., etc. So current liability means trade payables, sundry creditors, bills payable, etc. This will also be added. So this is the pro forma of consolidated balance sheet. So students, today I will conclude my classes, and next classes we will start in the practical portion of preparation of consolidated balance sheet. So thank you, students.